I am mining investor and editor of Resource Stock Digest, Gerardo Del Real, here with my partner, Mr. Nick Hodge, who's also an investor and the publisher of Daily Profit Cycle. This is the 222nd episode of our weekly therapy session that we call Investing in Bizarro World. We're going to talk markets, we're going to talk the Dow, the S&P, we're going to talk gold, lithium, fires in Quebec, and we're going to talk about some of the crazy stuff that's going on around us. Always plenty of crazy to get into. We're going to keep this one market focused for the most part. Mr. Hodge, how are you today, sir? I'm liking the stash.
Appreciate that. I trimmed off the handlebars, got the quintessential 70s or 80s stash now. Things are going well. Summer's already heating up. You mentioned the fires. The markets continue to think they're in a bull market, but as I wrote this week, like the newfound intelligence that the market has or is liking, it's this bull market is artificial. So I'm doing good. How are you?
I'm well. I'm fresh off a couple of day trip at Yosemite with the wife and the kids. That was phenomenal. It was beautiful. It's kind of a, it's kind of leaves you in awe, the scale and enormity of that place, right? Everything from the waterfalls to just the rock formations, the mountains. Pretty nice trip, but no, look, healthy, happy, excited for the summer. I see some contrarian opportunities setting up that I think are going to pay off really well in the second half of the year. As you know, you and I have both been writing checks the last couple of months in anticipation of the second half of this year. So, we'll get into the resource space a little bit later on. We'll get into some of the plays and spaces that you're dabbling in, but let's start with the overall market. It's Thursday, June the 8th. I can't believe it's June the 8th. And the S&P 500, just hit a new closing high for 2023. We had an unemployment report that, bad is good again, right? It was more unemployment than expected, and the market took that as a signal that maybe, Powell will pivot, blink, whatever you want to call it, but maybe slow down the pace of the rate hikes. As a result, have some cover to be able to do that. Bottom line is the market really liked it. The NASDAQ was up another percent. The S&P 500, as I mentioned, closing high for 2023. And look, the Dow sitting just below the 34,000 level. Thoughts on the overall markets? You already teased what you thought in the intro, but a little bit deeper dive into it. What are you thinking?
Yeah, the bear market rally continues. The S&P is getting close to 4,300. It's bounced away from that the past couple of days as it got up there. You had a really strong jobs number a week or two ago, like 339,000 jobs were created. But let's face it, this market is being driven by a couple of names. I mean, Apple's at a $3 trillion market cap. The NVIDIA hit a $1 trillion market cap. If you look at those names that are attaching themselves to AI, the sort of former FANG names, they're responsible for, I have it here because I was writing about it yesterday, those 7 names are responsible for 27% of the S&P, 7 companies responsible for more than a quarter. And if you look at the sectors they're in, which are technology, consumer discretionary, and consumer services, they make up an even larger portion. Like those 3 sectors right now are being weighted at almost 47%, half the S&P, just those 3 sectors. Yeah. There's 11 sectors in the S&P. So a lot of money has flown into them, right? I mean, AI has been a really huge thing. We mentioned it a couple of times on this podcast. And they've almost become sort of liquidity centers of their own. And it's liquidity that I'm going to talk about in this answer. But when you sort of step back from those 7 names and look at the other sectors of the S&P, over half the sectors are down over the past year. The earnings growth is still negative. Worse for the NASDAQ than it is for the S&P, but both had negative earnings growth in Q1. If you look at the economy, it's still slowing. The GDP, after printing 2 negative quarters last year, has been sequentially stair-stepping down. And you'll get close to flat growth again here in Q2. That number will come out in the end of July 27th, I believe it is. And if you look at like the ISM numbers, both for services and for manufacturing, they're printing contractionary prints. And so there's not a lot to be bullish about out there. You had a little run on the back of the debt ceiling, getting resolved, which, it always does get resolved. But now you're into the liquidity part of the debt ceiling drama, which not a lot of folks are talking about. And I mentioned it, I think, on this podcast last week, and I've written about it a little bit. Look, money supply is already like the lowest it's been since 1959, right? The Fed continues to tighten. I'm not talking about interest rates. I'm talking about quantitative tightening, 95 billion a month coming off the balance sheet. And now the market needs to come up with another 500 billion to $1 trillion in the next few weeks to refund the Treasury general account. And you start to wonder, where is this liquidity going to come from, if not from, potentially out of some of these stocks. And, you look back at those 7 stocks that I was just talking about, and they become sort of liquidity islands unto themselves. So it's not too far out of the realm of possibility or not a huge logic gap to think, these companies could quickly be drained of the liquidity that they had as this liquidity crunch continues. And it's not just the Fed tightening, and it's not just the Treasury needing to refill itself. Now you've got these student loan payments that are going to start back up here in August and September, because remember, that was part of the debt ceiling deal, and now we're getting some numbers tied to that. So that's like 40 million Americans paying an average of $400 payments, right? So $16 billion a month. $192 billion a year, I think the math works out to. So the market needs to come up with some liquidity. And that $400 a month, by the way, has gone a long way, I think, into these, personal expenditures that have been able to maintain over the past year, right? If you don't got to make your student loan payments since 2020, you can spend that on other goods and services, right? Well, that's going to go away. And so I think the can has been kicked a little bit. Like, I was looking for a recession this year, headed into Q3. That might get pushed out. You might bump along flat and have a really nasty start to 2024. So I still think you have a lot of time. I'm giving you a long answer. Sorry, but I wanted to make sure. No,
this is a great answer. I said in depth. This is in depth.
I wanted to make sure I hit all the points. Copper remains, relatively weak. Oil remains relatively weak. And I've talked at length, and certainly written at length, about the sort of the cascade of the business cycle, right? Where you have housings, and then orders, and then profits, and then employment being affected. And I know you put employment on the thing because you're finally starting to see a rise in the unemployment claims, right? And that's sort of the last shoe to drop in the business cycle. I think it's going to ultimately what gives the Fed cover to pivot, not pause, because I think you get a pause here next week. Yep. I think they don't raise, and then potentially they raise again in July, which the Bank of Canada and then the Royal Bank of Australia just did. They were relatively surprising rate hikes when people thought they were going to pause. And so I don't think we're out of the rate hiking cycle yet, and I think that ultimately it will be unemployment that gives the Fed cover to say, you know what, we're not going to get to 2% inflation, but we got to stop hiking because the unemployment is getting out of control. That might not come until Q1 2024 or Q2, and so that's the macro update, I guess.
You mentioned 7 companies making up a large percentage of the overall indices. We have to talk Apple. They had their, product rollout this week. How good do you think the porn's going to be on that $3,500 virtual reality AI headset?
I imagine pretty good. And, I hadn't really thought about it, but I was watching the NBA Finals with a couple of guys last night, and they were talking about the headset, and then they started talking about Port 2. It's amazing that you don't see, I guess, just the port industry in general making inroads into this, because that's like would seemingly be the first application, right? Just like they determined, wasn't it? They determined like the VHS Betamax wars.
Yeah.
The porn went with VHS, and that's why it decided to go that way. So I don't know how many people are going to pony up $3,500 just to watch some porn. That's a pretty steep price tag. But what do I know? I don't know why people pay for pictures of feet either, when you could Google them for free if you wanted them.
Everyone has feet. That's the weird part to me. Feet, not my thing, but no judgments, no kink shaming here to anybody out there. Look, jokes aside, Apple has been brilliant throughout the years at taking a product that already exists, waiting for everybody to mess it up, and then making it their own, right? By launching a better version at just the right time. They've done it with MP3s. They've done it with the iPhone. They've done it with, the cameras in their iPhones. They've done it with their chips and their processors. And
the AirBuds is a leading category too.
Absolutely. Absolutely. And so I say that to say, you mentioned the playoffs. There's, two people and companies I don't bet against. Jimmy Butler from Miami. He's an absolute killer and an absolute dog in the fourth quarter when it counts, though I think Denver has a better team. And I don't bet against Apple's products in the mid to long term. I don't think in the near term, even if you have it, right? I'm not ponying up $3,500 right now. No matter how good the porn is, no matter how many other applications it has. If you told me that I could get on this headset, sit down and watch a game at Wrigley Field from right behind home plate, or I could watch an NBA Finals game from, courtside, now we're talking. And that's where I'm really curious to see if they're able to strike partnerships with leagues and associations, be it sports teams, be it movie sets, be it whatever it is, to really make that a completely different, unique experience than what you would otherwise be able to experience. If you don't have the money, we talked off air a bit about a big boxing match, Spence and Crawford, that's happening on July 29th, that I can't wait for. I've been waiting years for this fight. But if you don't have the money to pony up for those tickets, and having an Apple virtual reality headset allows you to pay $100 pay-per-view and experience it that way, well, you might pay $3,500 up front to be able to have a ringside experience, a courtside experience, a number of these experiences that otherwise would cost you thousands of dollars a piece to have, right? So I'm curious to see what they do with it. I believe they actually will launch it in 2024 because they have had some production issues. I'm curious to see what they do with it. I don't bet against Apple product rollouts because they seem to do those really, really well. And they are clearly betting big on this $3,500 headset. That's not a price point that you just throw out there casually. So we'll see.
Yeah. I mean, I'd be all for it for the same reasons you mentioned, right? Especially at a time when people are paying $3,500 for not that good Taylor Swift seats, right? And you wonder, where all that money is coming from. I saw some going for over 30 grand Taylor Swift tickets. And obviously people are paying it. So that begs the question, where are they coming up with that money? And it's likely going on the credit card, but getting away from the Apple discussion there. It's actually cheaper. She's going to have some dates in Argentina, I was reading this week. And because of the you can fly to Argentina and buy tickets for cheaper than, it's still cheaper than going here.
And the wine is amazing. The women are beautiful. And, the weather, the people, awesome. Steak is excellent.
I was going to say little Malbec and steak. Yeah.
Yeah. There's worse places to be. Let's talk commodities. Gold in reaction to that unemployment number reacted really, really well, right? 1965, 1970 levels, still hanging out right around that 2000 level. The dollar index took a good hit, went from firmly above 104 to flirting with breaking 103. The last that I saw is 103.20, the last that I saw. Any thoughts on the gold space? Still liking the precious metals? Silver had itself a good 3-4% run.
I think I wrote over 1,500 words about gold in the foundational profits issue that's going to come out here on tomorrow, Friday, June 9th. Getting real bullish on gold, and you're going to have time to pick your spots. I mentioned a couple of minutes ago the surprise rate hikes from Canada and Australia. It's the interest rates that are controlling gold now more than the dollar. If you look at a chart of gold against the dollar and you look at a chart of gold against the 10-year yield, it's the bond yields that are correlating more than the dollar. There's been periods in the past couple of months where gold has risen alongside this dollar regaining strength, and so it's that interest rate question. And if you're of the belief, like I am, that there's still going to be at least another rate hike, even if it doesn't come in June, if it's July, that means you're going to have more room to buy the dip in gold, which is what I've been saying, is buy those dips. And there's room for it to dip. Short-term support for gold is down around the 1935 levels. So anything down there is really worth buying. And then It's bullish. Look, I could just rattle off a couple of things I was writing about. The gold supply since 2017-18 has been going down. It reached like 100 and just over 100 million ounces a year, and has fallen off every year since 2018. Demand is up. Central bank gold buying was at a record last year, something like 38 million ounces. The ETF inflows have been up for the past 3 months, after being negative for the 10 months preceding those. So people are getting more interested in buying gold. And then moving to the equities, there continues to be a disconnect. The gold equities are undervalued both on the larger side, the GDX and the GDXJ. What's the chart say? After the Fed paused the last time in 2015 and gold went up $300, to get back to the ratio the GDXJ was then relative to gold, it would have to go up some 80 to 90%, the GDXJ would. So the small end of the spectrum of the gold stock spectrum is poignantly undervalued. And so, pick your spots, do your due diligence, subscribe to your 5 newsletter writers, and pick their best gold names, because it's the time to get positioned.
I'm going to give y'all a freebie. It's a company that both you and I, Nick, I believe, correct me if I'm wrong, we both wrote a check for. That company is Kingsman Resources, KNG, on the Venture Exchange. Market cap, $7.35 million. It has consolidated a past producing district scale land package in northern Mexico. It is in a neighborhood that has multiple producing mines. The metallurgy historically has been great. It's more of a pure play on silver than it is gold, but it does have gold exposure to it. Really like the CEO, Scott Emerson. I think he's got a clear vision and plan for unlocking a lot of value in this district. It's the first time that this land package has been consolidated, and the first time by default that it's going to be explored as one whole package as opposed to just parcels of land, right? Parcels of land that have done very well historically, but I think that is one to watch. I'm a biased shareholder. That's a long-term position for me. But Kingsman Resources, that's your freebie of the week if you'd like to increase your precious metals exposure at a really, really attractive entry point, 7.35 million market cap Canadian.
Just set up a Patreon so people can start tipping us for these freebies of the week.
Click here for the picks of the week. I've talked about it in the past. You're in charge, Nick. You're in charge. Set it up. We have to talk lithium a bit. The lithium spot price continues to trickle higher. It's been about a week and a half, 2 weeks now of sustained higher prices, much like the uranium space, which we'll get into here in a minute. But, we got to talk about the fires in Quebec, right? I've had several paying subscribers write in, and I'll give you my thoughts because I've already issued an alert to them. But, write in asking about the fires in Quebec, how it affects Patriot, how it affects other companies in the area. And look, in the case of Patriot, they're actually very fortunate that despite having to halt all drilling activities, they have 27 cores at the very least to report on. So you're going to have, I think, multiple releases here over the next 30 days, next 15 to 30 days, with assays that I expect to be, again, just absolutely spectacular, what we've gotten accustomed to with Corvette. You also have a maiden resource estimate. Blair was on BNN here this past week, and I've spoken with him, and he's hell-bent on making sure that resource estimate, which will include 60,000 meters of drilling, is published mid-July. That's a month away, folks. A month goes quickly. So if you give me a news release next week with assays, if you give me another one 2 weeks after that, then you set the table up real well for that maiden resource estimate. And at that point, it's going to become a lot easier for some of these institutional funds that maybe, are getting pushback from, their holders or these other companies that maybe want to take a position but are getting pushback from the board that are saying, look, Patriot doesn't have a maiden resource estimate yet. We don't even know really what's there. We can't really break the data down in a cohesive way. Let's wait and see what that is before we make a move forward. And so I think that's going to come in. I'd be surprised if it didn't come in close to the 150 million ton mark, which puts it as top tier hard rock lithium deposit in the world. Puts it up there in that class of deposits. And obviously that's just going to be a snapshot because drilling, which will recommence, obviously the fires are an unfortunate scenario. Forget the markets, forget the Patriots of the world, just in general, right? And hopefully that gets under control and Mother Nature cooperates with us here in the next few days. But the bottom line is, if we get an announcement in the next week or so that, the rain is helping out and the fire threat is less, and these companies are able to start drilling again on a case-by-case basis, you have a catalyst-rich couple of months coming up with or without drilling. Obviously, we want drilling. Obviously, I want to see, the blob, as I've been calling it, all connect. Obviously, I want to see some exploration drilling in areas that have yet to be drilled in the past. But if none of that happens, Patriots sitting pretty with tons of cash, tons of catalyst. And, as for the other exploration plays in the region, I'll be real honest with you, Nick. Fall another 20%, fall another 30%. I'll be adding to my positions. Everybody knows, I have a pretty robust position in Q2. I'd be adding to that if that pulls back anymore. I have my eye on another company that got away from me, and I'll be adding to that position if that pulls back a little bit more. And for those exploration companies, a little bit tougher on the go. Q2 raised $10 million. Good on them. They're sitting pretty. But yeah, we definitely want some catalyst, and we want to be able to take advantage of the season with some drilling to start defining what could potentially be, another significant discovery and player in the James Bay region. Any thoughts on lithium or James Bay in general, or the fires, Nick?
I have a reader question about Patriot. If you want to take it.
Fire.
With PMET's upcoming MRE, the mineral resource estimate, what odds would you give it for 150 million, 170 million, or 200 million plus tons? I believe he's talking about. I believe the updated resource in 6 months will surpass 200 million with 30,000 plus meters or more drilled by then. Could it even be 230 million tons?
To answer the first question, I think we're right around 150 with the 60,000 meters that are going to be included in that maiden resource estimate. And now listen, when we get that estimate, you're going to have different numbers based on the cutoff grade, much like in the gold space, right? You could have a 5 million ounce gold deposit with a cutoff of 1,500. You can have, a 4 million ounce deposit with a cutoff at 1,600. So depending on what they use for a cutoff point on the grade, right? On the percentage on the lithium side of it, that's going to dictate to an extent what that estimate is. So what do I think the highlight number is going to be at whatever cutoff they decide to use? I think it'll be right around the 150 million ton mark. At the end of the day, it's just but a snapshot, right? I completely agree that in 6 months' time, we're at least at 200 million tons. I'd be surprised if we weren't close now, right? With some of the drilling that's gone on. But 150, I think, is a reasonable scenario. And I think, again, it positions Patriot really, really well for the average person to just use some common sense and say, okay, well, if there's 150 here, and that only includes 60,000 meters, and we're about to embark on the most aggressive drilling campaign, Mother Nature permitting, that we've ever embarked on, and we're fully funded, and we could raise another 50 to 100 million if we wanted to with minimal dilution to keep the rigs turning, you can't help but get excited and start imagining a scenario where 250, 300 million tons is easily achievable in the next 12 months. And again, it's going to be really hard for majors, whether it's chemical companies or, Irving Oil just decided it's getting out of the oil business, right? It sees the writing on the wall. It's going to be really hard to not get in there and make a serious run at this thing. And if they don't, great. I'll sit on my shares. I don't care when it hits 50. 50 may prove conservative if we get to 250 million tons in the next 12 months.
Well, let's hope the rain in St. James falls gently or not gently on the spodumene.
I hope it goes like it was going at Yosemite. I tell you what, that'd be a welcome sight, because I think all these James Bay plays are going to rip higher, much higher, the minute, the order is given that they can go ahead and go back to drilling. I mean, look, I've talked Q2. I mentioned Ophir last week. I've talked Patriot. Those rigs are ready and the cash is there. The treasury is full. They're ready to go. They're just waiting on the green light. And then I think it's off to the races for the rest of the year. And I think it's going to be a fun and profitable second half of the year. And look, you and I just did a private placement on a private play that has some Australian assets and has some Canadian assets that I think, is going to do really, really well with some things in common with the people at Patriot and some other groups in the James Bay region. So when that goes public, we'll bring that to you after we bring it to subscribers. But I'm excited. I'm overweight lithium. I have a ton of exposure. It's a large part of my portfolio. Patriots, a large part of that, but there's other positions that are pretty robust as well.
Yeah, and I don't have any thoughts on the individual companies, but I did want to give a quick update on lithium because there was a new report out, and maybe we can put a link up to it in the description. But it's from Bloomberg New Energy Finance, and it just came out this week. It's an update to their long-term electric vehicle outlook, and I'm just going to read you some of the highlights real quick. So they're saying that sales of EVs across all segments are going to hit $8.8 trillion by 2030. And then 20 years later, in 2050, they're going to ramp to $57 trillion. And then they're talking about having 100 million passenger EVs on the road by 2026. And then 14 years later, by 2040, that ramps to 700 million electric passenger vehicles on the road. And that's up from 27 million here at the start of this year. So even just looking at their 2026 number, 100 million passenger vehicles, I mean, that's 4 times more vehicles than are on the road right now. And then if you scroll down to the resource part of it, it says lithium supply is the most concerning of the battery metals in terms of supply sufficiency, with demand increasing by a factor of 22 times by 2050 in their net zero scenario. So, the shortage isn't going away. The market is moving increasingly toward hard rock, toward spodumene, because it's easier to create the hydroxide. And so I think those prices are going to remain robust. And so lithium remains fertile ground for resource speculation hunting for sure.
Absolutely. There's a ton of money to be made in the space, folks. I mean, I know you hear it every week, and I keep telling everybody. Look, I had a friend that just took a huge position in Patriot this past week and a half, right? I have another one that wants to take a bigger position, and they're already pretty overweight on the stock. So a lot of runway, a lot of these James Bay plays. I think that soil is fertile for some big major discoveries. I think the real legit players are going to surprise to the upside. And look, there's going to come a point where we talked about this about a month ago, where all of the capital that's spread out over the speculative plays, some of those aren't going to work. Most of those aren't going to work. All of that capital is going to leave, and it's going to go into the creme de la creme like it always does. And I think a couple of our horses are gonna continue to do well, Nick. I think we're going to be all right.
I was reading Howard Klein's newsletter. He puts out a lithium newsletter. I don't know if you get it. If you didn't, if you don't, I need to share that with you, the most recent one. And he was saying there's an undersupply of lithium, but an oversupply of lithium investment opportunities.
Isn't that always the case anytime something's hot, right? And look, and no names and no shade, right? The pie is big enough for everyone. But I remember when prices were, coming down in the pullback and the consolidation in the lithium space for a little bit. There were a lot of newsletter writers and people on Twitter, which isn't the real world, but some of you are real people, that were really happy about that because they had, that had missed the run up, right? And we're starting to make comments, the bubble is popping, and right, now all that money is going to disappear, and it's going to be a round trip, which was never the case, right? I know our paying subscribers were told in very clear terms, this is temporary, it's healthy, it's a good consolidation, add on this pullback, and a lot of you. And y'all know who you are. I've gotten really quiet about that lithium bust. A trend is a trend is a trend. Y'all make it your friend. It's not about being right sometimes. It's just about making money for yourself and subscribers. And that's kind of, where I try to go where the puck is, like the great Wayne Gretzky used to say, right?
What else did he say? You miss 100% of the shots you don't take?
Yeah, all the good things, right? Shooter's going to shoot. That was Michael Jordan. Everybody's got a plan, so you get punched in the mouth. Mike Tyson, I could do this forever with y'all. Anyhow, speaking of where the puck's going to go, uranium. We've been telling you to get those uranium positions dusted off, and we told you the consolidation, much like the lithium sector, was close to a bottom, and sector sentiment was close to a bottom. And for the last month, we've been banging the table saying that the disconnect between an increasing spot price and the explorers and frankly some of the producers was widening too wide, and there was going to have to be a reversion to the mean. I think that started about a week and a half ago. Spot price closer to 57 now, closer to 60 than it is to 50. I really like the setup in uranium. I noticed the utility came out, wrote a contract at higher prices. I think that's going to be the first of many. I see a coiled spring in the uranium space. I think, again, much like lithium in the second half, much like gold in the second half and copper next year, I think we're in for a historic run in the uranium space. And again, I'm acting accordingly and positioning in that sector as well. Any thoughts on the uranium side of things?
I've given you a lot of uranium thoughts over the past couple of weeks, so I don't have a lot new there. I mentioned the funding for small modular reactors. I mentioned the bill working its way through, which has now been approved, by the way, for a vote on the floor. We'll see if it gets there to ban Russian uranium imports. There's even talk about potentially attaching it to some other must-pass legislation. So those are all known things. First on the commodity, I guess, is, it's decoupled from the CRB commodity index. The CRB commodity index has retraced its gains by 20% from its highs last June. And so that's a textbook correction, and it continues to bounce around there. Some days it's down 22 or 23% from its highs, but it's trying to hold on. We'll see if it breaks into true, bear market territory. But still in the context of an overall super cycle that could last 10 to 14 years. But nonetheless, with that commodity pullback that we've seen, uranium is hitting 52-week highs, which you mentioned. It was $56, I think, last week. It is closer to $57 this week. And so I've seen some other newsletter writers mention that disconnect in between the price of uranium and the price of the uranium equities. And then I guess the only other thing, and it's not too enlightening, but it is jurisdiction and why it matters. And I've said over the years that I don't really dabble in uranium companies in Africa, whether that's GoviX or Global Atomic. And somebody asked me to rattle off some uranium names. I wonder if I'll just keep going and talk about some of them. But
do it. I'll get your money's worth this week, everybody.
You saw or maybe you didn't see, in Namibia, there's their minister of mines and energy has been basically talking shit about nationalization. So this started back in March, where he said, basically the situation where all these foreign companies own all our mineral and energy assets is untenable. He called the situation untenable. And then in the last week of May, he said, we're going to be looking to nationalize these. Basically, we're going to be looking to get our piece. He said, I'm paraphrasing. We're going to be looking to get our piece without paying for it. And then
I figured you were paraphrasing when you said you were talking shit. Or they were talking shit. I didn't take that as a technical term, but as you were.
And then the next day, his ministry walked it back, right? No, we're not thinking about nationalizing any of these assets that are existing, but they left the door open to taking their pound of flesh from new contracts or new permits that were issued. And it matters because, it's one of the largest uranium producing countries in Africa. It's one of the largest diamond producing countries in Africa. And there's been some significant offshore oil and natural gas discoveries in recent year by Shell and others. And so jurisdiction is important. And it's one of the reasons, first of all, the stocks gap down. Langer Heinrich is in Namibia, for example, that's owned by Paladin Energy. And the day that those comments came out, the Paladin gapped down in Australia, tripped the circuit breaker, and the stock was halted. It was down 25%. And then there were some others that were down as well. And so, jurisdiction matters. I don't believe that's going to happen in the U.S. Southwest. I don't believe that's going to happen in the Athabasca Basin, for example. And so just something to be conscious of when you're looking at resource stocks in general and uranium in particular. Do I want to talk about a bunch of stocks? I don't know. I can talk about the ones I own. I mean, I'm not going to go down the list of all the explorers.
Give them two, Nick. Give them two.
I mean, Energy Fuels is a great company. It was really worth buying back in March when we bought it in the Hodge Family Office weekly letter. But it has its hands in lots of things, right? Not only does it have the only mill in the Southwest, the White Mesa mill. It's not just uranium, right? It does have uranium assets, obviously. It can also process them, but it can process rare earths. It can process vanadium, right? And all of these are those obscure, critical energy minerals that are needed for whatever, flow batteries or magnets to make all these motors. And so Energy Fuels has its hand in a lot of things and is a real high quality company. I'll give you one that's not in the letter that I still own, and it's, a well-known one. It's Encore. I know it's in your letter, so sorry.
No,
I own
okay.
I own those shares as a result of, well, gosh, it was three companies. It was URZ, and then it was Azarga, and then Azarga was taken out by Energy Fuels. But they're rushing headlong into new production here down in Texas. They've got their plants in order. They're shedding their non-core assets. They just sold one this week or last week, I believe it was, to Anfield, I think it was. And so that chart has been perking up nicely and still nowhere near the highs it was when this uranium sector was going fervently a year or two ago. I think I'd look at it in Canadian terms because that's the shares I hold. It's at like a 350 or something, but it was in the $2 range just a couple of weeks ago. And so, those are two I look at sort of in the middle of the spectrum there, not quite the Camicos, but have assets that are at or near production.
Again, it's a free podcast, y'all. Getting your money's worth. You get my loud self, you get Nick's round self, and you get your questions answered. Y'all keep coming with the comments. I absolutely love the comments. The good ones, the bad ones, the mean-spirited ones, the kind ones, all of them. They're fun, and we appreciate the engagement there. It's good stuff. And speaking of that, we did have another question, I think, right, Nick? There's like the one or two notes that we wrote. The rest of this is all freestyled, by the way, everyone. What was that other question?
There was one about, there's two more. There's one about colored ties, and I can take that because that gentleman has asked about colored ties a couple of times. And essentially, this is a company, and I don't know too much about it. I just took the time to read the latest financial statement and management discussion and analysis to answer this question. They own something like $24 million worth of Patriot Battery Metals shares, yet they trade at a $13 million market cap. And so the question is essentially why, if they have $25 million worth of Patriot Battery Metals shares, are they trading with a $13.5 million market cap? And this is a company that's essentially an investment company from what I was able to quickly discern. They have investments in lots of different early stage companies in wellness and med tech and resources, obviously. What I looked at, basically my quick takeaway was that a good portion of their other investments outside of Patriot aren't doing so well. And I think the market is taking that as a cue to not let them be fully valued for the Patriot Battery Metal shares that they do have, essentially questioning their overall investment prowess when it comes to other sectors and other positions that they have, because the balance sheet looks good. The share structure looks relatively good. There are some outstanding warrants that represent like a potential 10% dilution. And they're also trading, those warrants are priced at 80 cents, which is not a surprise why the stock is stuck at 79 cents, right? And so sort of those couple of things, the other investments, the little warrant overhang would be for me, again, just with a quick read, why it's not getting, the value commensurate to those Patriot shares it holds. And at the same time, I think it was you who said this when we were talking before the thing, if you want to own Patriot Battery Metals, like just own Patriot Battery Metals, right?
Yeah, bet on the horse and the jockey. Sometimes you just have to keep it simple, folks. And the smartest thing that I've done with Patriot is just hold 90% of that position from 16 cents, including the warrants that I exercised, right? And so that's been the easiest move, despite all of the volatility, despite all of the 50% retracements, 60% retracements after it hits new all-time highs. It did that for almost a year straight. You just look at the fundamentals of the company, you look at the peers, you look at the macro situation for lithium, and to me, I'd have to be a fool to be selling my Patriot shares if Patriot keeps performing the way that it has performed, and it's done so month after month after month for me. As far as execution on the ground and corporate development wise, the share price is just going to be a reflection of that at the end of the day. And so, again, I've seen comments about, oh, Gerardo thought it was going to be $50 by now. Well, according to peer comps, it should be $50 by now, which is why I'm holding 90% of my position. But, for those that want to take their profits, you're not going to go broke taking, whatever your percentage profit gain you've already had. For me, I don't mind writing out the bulk of that 90% position until at least $50. And Nick, I have to tell you, I'm starting to think that $50 might be conservative here over the next 12 months. I am. I really, really am. But I'll keep that to myself for now. Let's see where this maiden resource estimate comes out. Let's see when drilling resumes. I hope for, everyone's sake that these wildfires are, that they moderate and that they are under control here in the near term, not just for obviously the resource space, but just because it's a good human thing to want, right, Nick?
Oh, sure. The fires are no good, and the East Coast is freaking out for the amount of smoke that we get here in Spokane routinely. But I hope it lifts soon. You mentioned the warrants you exercised in Patriot, and that's the last reader question we had, and it came from a different gentleman a couple of weeks back. I think it came after we did an episode about private placements, and I thought we covered warrants, but he was asking essentially, what is a warrant? I switched tabs. Let me get back to it. How do you define a warrant, and what are some of the benefits and drawbacks? You want to take it?
Absolutely. Look, in very simple terms, I'll make it a quick, sweet, short answer. A warrant, when we participate in a financing, oftentimes we will pay, I'll give you an example, the Patriot Battery Metals example. We paid 16 cents for the initial financing when we got involved. That gave me one share at 16 cents, and it gave me a warrant, the opportunity to buy another share at 25 cents for the next 2 years. Regardless of what the share price increased or decreased, I always had another option to buy a share at 25 cents. And so needless to say, with the company here at the $16 level, at any point, exercising the warrant, paying 25 cents for the right to buy that share, it made absolute sense. And converting that, having the right to buy that share and converting that by paying the 25 cents was very, very, very profitable and continues to be, and is a part of why, I was able to get the position that I was able to get. And that in a very short version is what a warrant is. It's used as an incentive for accredited investors that participate in these private financings, and it's used to attract, the capital that the company is hoping to attract. So that in essence is what a warrant is. The right, but not, it's not mandated, just the right to buy another share at a predetermined price for a set amount of time. And, you get one like a Patriot, it can be very, very profitable. Those add up really, really quickly, folks.
Yep. And like you say, you don't have to do it. So at the end of that 2 years or 18 months or whatever the term of the warrant is, if they're not in the money and you don't exercise them, they just expire worthless, right? They roll off. And you no longer have the opportunity to do that, or they're no longer in the share capital table of the company. And so the benefits to you as an investor are that it's a way to get additional exposure without having to pay the current trading price of the stock if it goes up. And there's really no drawback to you as an investor by having the warrants. The drawback in some cases could be to the company, right? Where just like I was talking about a second ago with Colored Ties, where there's a lot of fully diluted shares out, right? There's a lot of warrants out. They issued too many full warrants. And so it creates a share overhang, or creates a situation where if all of those warrants do get exercised, it creates a higher share count, right? Dilution. And then depending on where they're priced, it can create an overhang too, right? If, the price of stock sometimes rises to the price of those warrants and sort of gets stuck there because it knows all those warrants are going to come in. If the share price does cross that, or maybe people are selling right at that price to exercise warrants, for example. And so those are the drawbacks, but not really to the individual investor, more to the overall trading and share structure of the company. So hopefully that was helpful.
Yeah, hopefully that was. I encourage everyone to check us out at dailyprofitcycle.com/subscribe to comment on my hair, my loudness, Nick's roundness, Nick's mustache, or anything you'd like to opine on in the series of tubes that we call the World Wide Web. Nick, anything to add to that?
No, I don't think so. Fed meeting next week. The market will be watching closely. Enjoy your summer, and we'll see you again next week.
Enjoy it, folks. Have a good one. Be kind to each other out there. You don't have to like each other. Stay away from each other.
Hey there, you independent-minded investor. If you like this video, make sure to tell us so by clicking the like button below. Subscribe to our channel so you never miss another one. And share it with everyone you know on social media. You can also click the link in the description below to check out more information-packed videos just like this one. Thanks for watching.